Hi, everyone. This is the Origin QOZ Fund 2 update webinar. Thank you for being here today. I'm Michael Episcope, co-CEO of Origin, and I'm here today with Kyle Verhassel. Kyle is Senior Vice President of Acquisitions, and he's joining us from Nashville today. Welcome, Kyle. Always a pleasure to have you on. Kyle has been with Origin for more than 7 years now, going on 8 years. He joined us as an analyst. He's worked his way through investment management and now spends all of his time unearthing great real estate opportunities for this fund and our other funds. It's been an absolute joy and pleasure to work with you, Kyle. Thank you for being here today. And I have no doubt all of you are going to benefit from his insights. Thank you for your questions in advance. They really help shape these webinars. These webinars are for you. They are supplemental to our quarterly reports. And Kyle and I are going to try to keep this presentation to less than 40 minutes, hopefully to about 35 minutes, and then open it up, I think, for everybody's favorite part, the question and answer sessions. This is an update webinar, just as a reminder, and it's not a place to get basic questions answered about QOZ law, about fund fees. If you have questions about that, you can find those on our website, origininvestments.com. We make it super easy to download our decks, get in touch with us. You can do that right on the website, or email investorrelations@origininvestments.com. And if you're a current investor, just email your dedicated investor relations contact as well. Let's jump in. I'm going to share my screen here. There we go. Looks good. Our disclaimers. And as always, we start with the capital markets. A lot of volatility in the markets these days, and we get a lot of questions about interest rates, cap rates, construction costs. And the last 18 months has really been characterized by volatility. One of the most volatile periods I can remember in the capital markets since 2007, 8, 9, that period. And we have been hit by every headwind you can imagine in this fund since we launched it in late 2021. 10-year interest rate, it's risen from 1.5% all the way up to 4%. We've got construction costs that have risen 30 to 50%, depending on what market you're in. And we've got cap rates also that have kind of followed interest rates as well. And the low in the market at the height of 2021, cap rates were 3.25, 3.5. You can pick it depending on the market, and they're close to 5% today. And it certainly doesn't seem like the Fed is done raising rates. Inflation is coming in a little bit hotter than they've wanted, and they've telegraphed that, and the market is now sort of reacting to that, the stock market, that is. And my belief is that they're going to get the job done, that you don't fight the Fed, they're going to get inflation down. And the question is always, at what cost? Is it going to be a soft landing? Are they going to break it? Is there some catalyst in the market we don't see today? It's hard to tell sitting here right now. But of course, right, with all of these headwinds, we've been negatively impacted in this fund to a degree. But keep in mind that this fund is 10, 20, 30 years, that this is going to be behind us in another year, 2 years, and we're going to get to the other side. I will tell you that I think we're in a far better position than I could have ever imagined, given both the magnitude of change in these inputs and the speed at which they occurred. Now, what's helped us and really everyone over the last 24 months is that rent growth has been incredibly robust and countered many of these headwinds. And we've made what I would consider really good long-term decisions that are going to help us get through to the other side, whatever the other side is here. We have great sites, we are in growth markets, and we've used leverage responsibly. That's a recipe for long-term success. And when we think about risk management, we always view the world in terms of downside. How do we protect downside? How do we survive through a recession? It's not always about maximizing upside. If we can capture 80%, 90% of the upside, but protect ourselves in markets like this, whatever this is, that's what we are in the job of doing, protecting and growing capital with protecting, highlighting that. And this fund, because it's 10, 20, maybe even 30 years, depending on how long you're going to stay in it, we're going to see multiple recessions. And as a student of the game and looking back, what other sponsors have done well for the last 10, 15 years, we always analyze these things and stress test. And we're going to go over some what if scenarios in a few slides. There are some positive signs in the market. We see construction costs. They're starting to fall in some markets. In other markets, they're stable. They're just not rising. And so, we are getting some savings, and we're seeing the Fed is actually doing their job. And some of these contractors, they're still busy, but they're bidding competitively now. You, as an investor, you likely had other choices when you decided to invest with us. And I think you're going to be very happy choosing this fund over any of our competitors. I know I am. This is where I invest. We invest our money here, my partner and I. And what I believe is that we're going to outperform other managers during this period of volatility, uncertainty, no differently than we have for the last 8 years in our other funds. Let me jump to the next slide. This is our rental growth rates. These are the cities where we are invested, and this really captures what kind of a recessionary environment. And this was created by Origin Multilytics. And what we've asked Origin Multilytics to do, this is our proprietary rent prediction tool. It's AI in its best form. This has been something we've been working on for 3 years. If you're not familiar with this, we actually have dedicated webinars to this, but we've asked it to really crank up what does the downside look like in our markets, given the supply, given some of the economic forces that are out there. And you can see here, we're forecasting negative rents for the next 12 to 18 months in our markets because of the deluge of supply coming. There's about 1 million units being delivered across the United States, with many of those in the Sun Belt markets. But keep in mind, the historical average is about 350,000, just to keep pace with population growth and supply that's deteriorating and coming offline. Supply is going to outstrip demand for the next 12 to 18 months. This is just part of the real estate cycle. But then what we see is a rebound in 2024, 2025. And I do want to caveat this. This is our proprietary rent forecasting tool, and this is the way we look at the world. Risk management, again, it's something that we think about. And what do we do if the market is going down? What decisions are we making differently today? When you think that the world and the market is actually going to be declining over the next 12 to 18 months, you make very different decisions than if you think everything's normal and going to grow. So we've been in a defensive posture here at Origin for the last 24, even 36 months, understanding what's going on in the post-pandemic world, and we're still doing that. So all of our conversations are about stripping out the risk out of our deals. Other forecasting services, so there's about 14 of them out there, a couple who are in the top. They're all predicting, all but 2 are predicting positive rent growth next year. It could be that they are right. They have a much rosier outlook of the world. Our prediction tool has proven to be more accurate than theirs. And I don't think that given what's going, when you see the inverted yield curve, what the Fed's doing, the supply, I believe ours is right. And we're preparing for that as well. The more important thing here, and something you should focus on, is that rents in our markets are forecasted to be positive over a 5-year period. And generally, they grow at their long-term historical average rate of around 3%. The fund is allocated, and this is by design, to the higher growth markets of Atlanta and Nashville. We actually use Multilytics strategically. We want to be over allocated to markets that have higher rent growth over long-term, because there's a huge difference in wealth that's created in a market where rents grow at 1% versus rents grow at 5%. And because we're in this fund for an extended period of time, you have to get the market right. And that's what we're doing. That's one of the most important decisions we can make here, because and it's also, by the way, one of the reasons we don't invest in Chicago. I'm sitting in Chicago here. It's a low growth market. I love Chicago, raised my family here, but we've decided our investment dollars have better places in this country. And so that's why we're in the Nashvilles, the Tampas, the places that are really benefiting from work from home and that are going to continue to benefit from work from home. The other thing to consider here is that there still is a housing shortage in this country. And once this supply is absorbed, we're going to continue on the long-term upward trajectory in this market. That's not going to be solved by the million units that are going to get absorbed. And we haven't delivered anything to the market last quarter, even the second or third quarter of 2022. Construction has stopped largely in the first quarter here. So 2025, going into that 2026, you're going to actually have a lack of supply. And that's why we see the markets bouncing back on the rental growth side. I'll jump to the next slide here. This is our portfolio summary. We have raised already $277 million of a $300 million hard cap. So there is limited availability in this fund right now. If you are interested in investing, I highly recommend you reach out to investor relations, to your dedicated investor relations contact to talk to them, reserve a spot in this fund. We always see this in every fund as we get closer and closer to the end. The scarcity of the fund actually drives demand and people start jumping in. So I wouldn't be surprised if this fund is fully committed from an equity standpoint in the next week, week and a half, even 2 weeks. The good news about this, if you're a new investor or even existing investor and you want to invest more in this fund, all of the equity is earmarked for investments that have been identified. So very different than a fund that is blind. And then, by the way, we're going to be coming out with QOZ Fund 3 in, call it 30 to 60 days, but there's going to be a small gap, and that's going to be a carbon copy of Fund 2. No difference really, except for the fact that we haven't identified assets for that fund. In this fund, we have 7 assets, but really 9 properties, because Sawtell and Edge Hill are multi-phase developments. And what I'm really excited about in this fund is our allocation towards build for rent. A third of this fund is in build for rent. And we really believe that's the most exciting sector in multifamily. Build for rent is how we describe it as horizontal multifamily. So you can think about it as single family rental, but it's purpose built, right? So this is an acquisition of a 10, 20, 30 acre parcel of land. We're building single family homes and townhomes, and we're really meeting the demographic that's moving through. And these are the millennials. They're reaching prime buying age, but they value flexibility certainly more than any generation before them. And home ownership is unaffordable. Everything we've seen, all these headwinds I talked about earlier on the multifamily side, they also exist in the home ownership side, buying a home. Mortgage rates are causing the combination of mortgage rates and construction costs they've made home ownership unaffordable. Certainly today, renting is a far more better calculus than buying. And BFR, short for build for rent, it really captures this demand segment because these units feel more like a home than an apartment. Little bit maybe about risk on this fund. Our loan to cost is 62%. And you should know, if you don't already, we typically use 2-to-1 debt to equity. So we put in a significant amount of equity into our deals. In this fund right now, we've got 38% equity in the deal. And you can see on the right-hand side there, the various states that we have exposure to: Georgia, Tennessee, Florida, and Colorado. This next slide is about risk management, and I've already alluded to this a little bit. Ground up developments, and that's 100% what this fund is. It's all ground up developments. They're capitalized with floating rate debt. And there's risk in that. We've seen it as generally there's a spread above SOFR. And as SOFR goes up, your cost of debt goes up in these. And you generally can't mitigate that if you are in pre-development or you don't have a loan. If you have a loan, you can enter into something called swaps with the bank where you have an interest rate cap. And most of you may know, probably do, you can see the Wall Street Journal article, they picked this up, but we placed an interest rate hedge on the portfolio about 15 months ago. And that's worked out very, very well. And what an interest rate, what a swaption is, and that's what this is it's really an option on interest rates. And these were for the developments that we're in pre-development. We don't have a loan yet. They're still out. And that turned out to be a great hedge for us and for all of our investors. And we made close to $10 million in this fund. And that's to the benefit of this investors. And that's across realized and unrealized gains. We still have some of the swaptions on. The ones that we took off, we've booked that profit, and that really helps us pay the higher interest over long periods of time. The other part of risk management, and what you likely don't know, is everything we do behind the scenes on an everyday basis to protect your money and ours. And just because an investment was approved 6 months ago doesn't mean inertia takes it through and it's just approved today, especially when the market's moving like this. Every deal has to be reapproved and pass scrutiny in this new market. And our minimum thresholds have certainly increased because of the market dynamics. And if a deal no longer works, we're going to find a way to make it work or kill it altogether, because we are in the business of generating long-term investment returns. And if we can sell a piece of land and replace that deal with a new deal that has a higher margin, we absolutely will. It's a go, no-go decision at every point in time until we break ground. Once you break ground, you have no choice but to finish the project. We have several properties that are in this stage that haven't started going vertical. Edge Hill is one of them. Kyle is going to talk about that in a few slides in a little bit more detail. We spend every day, though, finding ways to strip out the costs, make these more profitable, value engineer them. But value engineering is really about stripping out costs without sacrificing quality as well. And some things we're doing and looking at Edge Hill and these other projects, changing construction type, negotiating prices and contracts, deferring the development fees if necessary, having that conversation with our partner as well. The investment management team at Origin, though, they wake up every single day looking for ways to strip out costs and generate the highest risk-adjusted returns they can for this portfolio. It's an iterative process, it's ongoing, and it helps us achieve our goal of protecting and growing. And I think that's an important thing that maybe we don't talk about enough, is what we do behind the scenes to make sure that we are in a great position to succeed both in the short term and the long term. This next slide is about fund level projected cash flows. And we always get questions about this because we don't have to pay our taxes really until 2027, recognize them in 2026. And when we started in 2021, this fund, we believe we could return 30 to 40%. Well, the curve has really moved since then, and higher interest costs, higher cap rates, that's going to affect not only our cost of operating, but also our refinancing costs. And that was a very different environment. Banks are lending less today, and all of this has impacted the math of how much we can return. And today, the cash we're going to be able to refinance, sitting here today with all the variables and inputs and what the capital markets look like at this moment in time, it's somewhere between 0 and 20%. We don't know, though, where the capital markets are going to be in the next 3 to 4 years. We see how volatile the market can be in the last, over 18 months, let alone trying to forecast over 3 to 4 years. And it's incredibly difficult. And we do this for your benefit. letting you know where we stand at a moment in time. It could be, though, that long-term rates are below 3% and we hit a soft landing and banks are lending again and real estate is taking off. And if that's the case, we could be right back to where we were from our original pro forma, returning more than 20-30% of your capital. This is a moving target, and we're going to continue in all of these updates, give you the information, the most up-to-date information we have based on where we are in the cycle. My advice to anybody in this fund, whether you're in it or whether you're getting into it right now, is that you should be prepared to pay your taxes with another source of funds. Risk management is something we do on our side. I do it personally as well. And this is some of this is just outside our control. Understand, though, we are highly incentivized to return as much money as possible to each of you and as quickly as possible. And that is our goal, and that will remain our goal. This next slide is really about stress testing. We published an article about this last month. If you want to go see it, that's on our website. You can look under QOZ2 stress tests. You'll get a lot of detail there. I'm going to just serve this up, kind of the highlights of it here. This is a what-if analysis, and many of you ask this in some way or another. What happens if interest rates go up? What happens if cap rates go up more? What happens if rents go down? And that's what you see in front of you. And the entire stress test is based on valuing the portfolio at a 5% cap rate. You hear people whispering out there, cap rates are 6%, cap rates are 5%, cap rates are 4%. We're in the market. We see this. We actually think 5% cap rate today is sort of draconian. It's way at the upper end of what we've seen actually trading in the market. And for these sites, for these markets, for these quality of assets, we've still seen trades happening at 4.5% cap rates. And our portfolio, we're building to a 6% return on cost or a 6% cap rate in the future. So we're still capturing a decent margin on our properties. If you want to take our stream cap rate of 5%, there's still a 20% gross margin under fairly extreme conditions. What that equates to from an investment standpoint, after we're looking at debt, leverage, cost of debt, everything, is a 1.53 gross equity multiple. And that's in about year 3 or 4. And that is the increase. In other words, we're still looking at profitability to our investment, a 53% increase in our investment over the first 3 to 4 years at the property level when we're looking at the portfolio in aggregate. Some are going to do better, some are going to do worse, but generally that's how the portfolio looks to us when we are stress testing this. What you also see here are rents, our underwritten rents versus multilytics, and our underwritten rents are actually more conservative. And that's another form of what I would call risk management, is conservative underwriting. And just because our multilytics rents say, look, we believe that the underlying rents of the property are going to be at $2,300 in 3 or 4 years, if we can make the deal work, or we're looking to comps in the market, we're going to use those lower rents of $2,200, $2,100. So we leave ourselves a cushion. And that's what this is about. And keep in mind that the multilytics rents that we are using are based on an extreme recession forecast. So real estate is part art, part science. You have to have boots on the ground. This is why we have 4 acquisition offices around the country. We have people out there looking at the various comps, understanding, stripping out seasonality. And that's the art behind it as well. But the combination of both data-driven information and information that we're getting from being on the ground and understanding real estate block by block, because no piece of real estate is identical, and no submarket is identical either. So you really got to get on the ground and see the real estate. In our stress test here, rents would have to decline 15% or more. That equates to around $400 per unit per month, maybe even $420. And that's just for us to get to a break even. That's not to lose money at all. And keep in mind that that level of decline, that didn't even happen during the Great Recession. So I feel really good about where we are today. We have a significant buffer of protection here under extreme conditions. And the portfolio is doing quite well. That is it for my part now. And I am going to hand it over to Kyle at this time. So Kyle, over to you. Thank you very much.
Awesome. Thank you, Michael. This slide right here, update timeline, stabilization of assets. Not going to go through every single deal on here. I think the keyword to note on it is target stabilization date. This is, if you refer back to 2 slides, the back end of that lease up phase where deals are starting to stabilize. The one thing I want to point out, Michael referenced supply, that's getting a lot of headlines today. There's a lot being delivered in 2023 and early 2024, but there's very few deals getting started, and that's more and more difficult in this current environment. So as we look out to the picture back into 2024, 2025, we feel really great about where we'll be delivering. On that same note, 3 of the projects below, the Rise St. Augustine and the 2 Ava deals, to reiterate, those are build for rent properties. Over $100 million in equity in this fund is allocated to build for rent. We really like the tailwinds in that space and changing demographics. As a whole, overall, the costs of home ownership in the Sun Belt markets, I'm going to pick on the Southeast, but Atlanta, Nashville, Tampa, Orlando, have seen the cost of home ownership go up 40% more than the cost of rent. So said differently, Nashville last year, effective rents were up 15%. The overall cost of homeownership year over year was greater than 55%. So huge gap. This is further steering people to continue to be renters in that space. One other component along that same lines, you see a lot of development going on, and folks may see, especially in these Sunbelt markets, a lot of new homes being built. But if you look at back to the GFC and 06 and 07, before really the housing collapse, new home deliveries and starts are down 47% from that peak. And Michael iterated, there's been kind of a decade of under construction and supply. You've seen a lot of that come in the last 3 years, but there's still continued demand on that side of the equation. So we're very, very bullish on this renter. Those tailwinds are going to continue to be in our favor in the future. Two Rivers Ranch. So this is a opportunity in Tampa for those folks familiar with Tampa. This is in the Wesley Chapel, Zephyr Hills submarket. It's about 25 miles northeast of downtown, right off of I-75, major corridor going north of Tampa. A lot of employment hubs located in and around that area. This is an opportunity when we close on the land last year. Our base case was we could assume as of right 240 units. One of the upsides in this underwriting was that we could achieve additional density. There was a new legislation going through Florida, which is this gray water, storm water density bonus program. Our co-development partner brought it to us. They actually worked with Florida legislatures and putting that into bill. And so we're excited to announce that we did achieve additional density. So we went from 240 units to 324 units, an additional 84 units. What this means for you as an investor is our land basis was at 43.5 a door, which was market. We were able to decrease that down 35% to 32 by the additional density. So huge win there. This is something in layman terms, what it means is the stormwater density. It rains in Florida a lot, that water runs off. We're able to have a system in place. We're effectively able to recycle that water, use it for irrigation and the landscape at the property. So that was a great win. We anticipate construction starting in Q3. Things are moving along here. For folks on prior webinars or investor updates, this sits right next to a 3,400 acre master plan community. There'll be 6,000 homes. Those are under construction as we currently sit. The first set of homes will be kind of released for sale, kind of late Q2, early Q3, and continued phases and site work are ongoing there. The benefit we have is we don't sit in the master plan. We're carved out, so we don't have to pay HOA fees or any component there, but we get the benefit of the trails and everything associated with it. One update, happy to announce for those that get the Tampa Business Journal, just south of it, the same master plan developer closed on the phase 2. For the golfers on the call, David McClay Kidd, famous Scottish golf architect, some may know for Bandon Dunes. He is going to be having a championship level golf course and community there. Homes will be $750,000 to $5 million. They'll also have an equestrian barn. So just speaking to the demographics in and around this area and who's going to be, which will help the overall project. And then lastly, in that same article, so I can say the name, but Publix is in discussions for an LOI directly north of our site. When I say north, I mean across the street, which will be a huge win for this project and the overall master community. So we're excited to announce those updates on this specific deal and looking forward to breaking ground in Q3. Next slide, please. Edge Hill Commons. So Michael mentioned this earlier. This is a deal when you get down to real estate, it's all about location, location, location. This is one of the top located pieces of land in infill Nashville and around it. You got easy access to the Gulch, which is the main live, work, play neighborhood of Nashville. We like this asset because we're positioned near a block away, but you don't have the congestion and you don't have other buildings blocking your building's views or clouding your amenities and pool in that area. So we're super fans of this. As Michael talked about earlier, though, we're investment managers first and fiduciary to y'all on this phone. And so when we started our original design on this project, we have 5 buildings throughout. It's a multiple phase project. 2 of the buildings were going to be a type 1 construction. Type 1 construction is concrete and steel. Last January, when we were doing that discussion, the price of lumber, which is a huge input, which is not type 1, but type 3, which we pivoted to, and concrete was low. Since then, those prices late last year inversed pretty dramatically. So the lumber index, which is a proxy, not direct linear to the inputs, but close, was at around 1,1500. And there was no signs of that slowing down or going significantly below 1,1200. Today, that's kind of varies between 400 to 500 to give you context. And the price of concrete subsequently went up 40%. So we pivoted, switched. We had a very difficult conversation with our development partner to do ultimately what's best for our investors and best for the project long term. We have pivoted architect who specializes in doing this type of construction, very prolific in the Southeast. We have a full team. We actually had a 2.5-hour call this morning prior to this, but what that means in overall terms of costs on hard costs, we're able to save 20% in hard costs. It equates to $60 million across the whole project total, all the phases. So significantly increasing the yield that we'll receive on this project. All goes well. We're still on track. We hope to break ground end of this year, but super bullish on this deal. The revised programming that we have will still be able to deliver the same experience to our tenants to help drive rent here. And it'll be a very great asset to hold long-term. Everybody that comes and visits Nashville, it's right at the gateway of the city. If you're coming from the airport or if you're coming from the south, from Brentwood and Franklin, we'll see this. So focusing on attention to detail and architecture as we do with all of our projects, but this will be paramount because everybody will really see that and it'll be a legacy asset for the city of Nashville. Rise St. Augustine. So fun fact for those on the phone, if you ever find yourself in trivia, whether out at a bar or with your family, St. Augustine is the oldest founded city in the US. At 1565 it was founded. But this asset we really like. Michael talked about the build for rent segment, horizontal multi. That is one of the segments we're most bullish about. It's not just us, a lot of other investment managers in the industry. But this deal is in St. Johns County in Jacksonville. St. Johns County is some of the best schools in all of Florida. With the result of having some of the best schools, you also have really nice homes in and around the area, and that creates a high barrier to entry story. It's very, very challenging to get anything zoned or entitled in this city. And we're excited to announce our development partner, Rise, who we have a programmatic partnership with. This is our sixth deal with them, so we have a great working relationship. Was able to get access to this site. A bunch of the topic comes in around legislation and how does that change. When we originally presented this deal this time last year, it was not in an opportunity zone. It was a deal we were excited about doing. With the new legislation and some changing to mapping, this actually got put into an opportunity zone. And so we are even more excited about that, the ability to hold long-term on this opportunity. With that, to the location on this deal, hardest thing to get for build for rent is to get sites that are large enough. We have 34 acres here. Most sites are not able to get this close on an infill area. We're 2 miles from downtown St. Augustine. We're less than a mile from a Publix anchored little town center, less than a mile from what is called the Shipyards Project in St. Augustine. It's a little pier and harbor, a bunch of shops going in and around. So super bullish about this. And as we look, kind of study the facts on the cost of homeownership, no really reprieve coming in interest rates in the near term, as well as housing prices. The millennial population is looking for something a little bit different as they're maturing in life. And we see this being a huge net beneficiary to it and will be a huge subset of our renter pool here. With that, we'll jump to Q&A.
All right. Thank you, Kyle. Can you hear me?
I can.
Great. Thank you. It's kind of Kyle is from Chicago and spent many years in our Chicago office, and then he now lives in Nashville, and so you hear him adopting the y'all. I love it. I love it. Good stuff. All right, let me start with the question since you've been talking the whole time. I'll tee one up, and then you can tee one up as well. The first question is anything new out of Washington about the future of the QOZ program? So for those of you who may not be aware, last year there was a new bill floating around Congress that was going to extend the QOZ program through 2028 and then bring back the step up in basis. We have not heard anything new on that. My source told me that it's not a matter of if, but when. He thought for sure it was going to be done in the first quarter. First quarter is coming to an end. I haven't heard anything more on that. We're all hoping that the program is extended through 2028. That would give, for those who are in it, even more time to defer their taxes, right? And taxes then wouldn't be due till 2029. We'll keep you updated on that. But for now, I wouldn't invest in this fund if that's something that you really need, is a step up in basis or an extension. I think the benefits of the current deferral out to 2026 with taxes payable in 2027, and certainly the forgiveness of gains if you hold this investment for 10 years and a day is worth it. This is a great program, great tax incentives as well, just as it stands today. So that's it. Kyle?
What happened to Phoenix and Charlotte properties in fund previously profiled? Please explain. I believe this is from the Q4 update and the pipeline. The Phoenix deal was lost at Ballpark North. The Charlotte deal was lost at Eastland. Those deals, we didn't show a pipeline on here. Those deals are still under due diligence, being evaluated, receiving pricing, value engineering working, TBD on timing if one of those falls into the remainder of this fund bucket, and the other could potentially be to kick off Fund 3. But both those deals are still under control by us. We're working through design and pricing and seeing if any updates need to be value engineered to get those to make more sense economically.
Yeah, and that's an example of what I talked about before, which is risk management. And we may have shown those deals, in one of the previous webinars as deals that were likely in our pipeline, or maybe even we bought the land. And if they just don't pencil out, we're going to find other methods to either make them work or get out of them. Next question is there going to be a QOZ Fund 3? If so, when? I answered this a little bit, but yes, there's going to be probably in the next 60 days, and it's going to be a carbon copy of QOZ Fund 2. And we had some other questions about this, and there's really no difference between, or there's not going to be, QOZ 2 and 3. The big difference is, though, not in structure. The big difference, though, is that QOZ Fund 2, all the assets have been identified. So you're not coming into a blind fund, whereas QOZ Fund 3, that will be a blind fund. So we don't have assets identified as we're sitting here today. We certainly have a robust pipeline. All of our acquisition activities that we've been embarking on for Fund 2, those will benefit Fund 3. And so we'll be able to source deals faster. But the data set, for properties out there, QOZ, it's very small. There's 8,600, 8,400 QOZ zones out there, somewhere around those. About 5% of them are viable. I think we've got some of the best sites in the entire country, but this isn't an unlimited set of opportunities. It's very finite, and I think we've done a great job locating the best sites, but it's getting thinner and thinner out there. And I think that's one of the advantages of QOZ Fund 2 versus anything going forward.
How would you compare the land basis for Fund 2 projects with how the land would likely trade today? Above, below, similar? This would be the land basis we have in these deals is below where current market is. I think one thing to reiterate to folks is that a lot of these deals you see in the pipeline under construction, we've controlled via our partner for the last 18 months or plus. And so when they were able to go under contract prior to a lot of the run up in land. And so we're able to be beneficiaries of that coming into deals earlier, and the land basis and the locations that we have. We also, we see a lot of opportunities. And so a lot of them are like the Wesley Chapel, Two Rivers deal. We've seen deals trade 20, 30 a door above where our basis is today in the last 3-4 months, which makes us, not only in this fund, but every fund, make good investment decisions on a relative basis and feel really good about what we're doing.
Next question. This is from John. How will the fund handle gaps in the capital structure given higher interest rates? Will fund investors be offered the ability to invest in preferred equity if that is the solution to fill the gap? John, that's not the case as we sit here today. I think our investment management department does a great job of anticipating future gaps in the capital structure. And keep in mind, we're using a significant amount of equity to begin with, and we still are developing to a very high gross margin. And so if you're developing and you're putting on pref equity in the beginning, and you have a capital structure with 85% leverage and only 15% equity, even if you do your job, you're probably going to, you're not going to be able to refinance everybody out of that situation. So in our case, I don't have a concern that we're going to be able to refinance and take our debt out. And that's a lot of advanced planning on the front end. If we did that, that's something we would decide in 2025 or beyond, when the portfolio becomes more stabilized.
Next question: which projects are progressing the smoothest? Which projects have been the most difficult? This is a great question. Development is always a very challenging business, but as Michael alluded to, we have a great investment management team, construction management. We're also co-developers. We're one of the more hands-on LPs. That being said, the projects that have been running the smoothest along Rio Grande, that's their third deal with Greystar in Colorado Springs. The build for rent Ava deals, we actually are doing some horizontal work on those. Those have progressed smoothly. Which deals have given us the most challenges? We touched on Edgehill a little bit. Us as a fiduciary and risk manager have to be able to make the call on tough decisions to make sure it's economical. Those are not easy conversations to be had, but they're the right conversations to be had. I think also and this is more globally on all projects, it's not easy to get deals done these days. You're dealing with cities and permits and extending time. So our team has really done a great job of staying on top of that process and making sure we have expediters where possible to get things out of the ground as quick as possible.
This question is from John. When will the NAV get updated and move from $10? Do you think we are currently below $10? John, the NAV is going to be updated after we close the fund. That's when we will actually mark the property or the fund to market. Do I think it's above $10? I think the swaption program significantly helped us in this fund, adding $10 million to the income of this fund. You have to remember, though, in ground up development, in the beginning, everything's marked at cost. So you're not marking things up until they are actually, you're adding value, you're putting equity in, you're putting debt in, you're building, you're creating value, you're getting closer and closer to stabilization. We have an entire policy that revolves around valuation practices and best practices. And so right now, the fund is probably at $10 because we don't have a lot of projects going vertical. But as we move through time, you're going to see those marked up. And I spent a little bit of time on that stress test showing where we're going to be in about 3 to 4 years at that 1.5 multiple. And in 5 years, from a growth standpoint, you actually continue. Your IRR is still high in years 4 and 5 because in 3 years, you've only done that first lease up, and the second and third lease up, actually, you're able to raise rents much more during those periods as well. So we're anticipating something close to pro forma after 5 years, and we'll update the NAV on a quarterly basis.
Next question live from John. Would you consider distressed QOZ assets from other funds to lower cost of development? This is a great question. I mean, the fund's primarily strategy is to be in ground up development from the start. However, this is something we're monitoring as acquisition officers in the market to see if an opportunity would come in. I will say, to meet the QOZ compliance, it has to be before C of O is given. And so if that would be the case, we would come in the middle of construction. It would have to be the right opportunity with the right GC in place and partner, just because of the amount of complications and potential liens and other components for it to be a true distress. But it could be an area where we could come in if costs came up and they don't have the equity to come in. And that could bode a potential opportunity for QOZ Fund 3.
Next question. This is by Anonymous. Given the lower projected refinancing proceeds and other market headwinds, have you changed your net return projections for the fund? The answer to that is no. I talked about this earlier, just the capital markets, the volatility, the uncertainty we're in today. This can change a lot in the next 12 months. 3 months ago, the 10-year was below 3.5. Today, it's hovering around 4%. I think the Fed's going to do their job. They're going to get inflation under control. We're going to see interest rates and cap rates come back down to earth a little bit. And if you remember several slides ago, we're still projecting kind of the average historical long-term growth in multifamily of that 3%. And when we're looking out 10 years, this is a moment in time. We'll get through it. We'll get to the other side. It's not the last recession we will have to go through and weather in this fund. And this is just part of the cycle of being in real estate. We're going to do very well in this fund. We're in the right markets and have some incredible deals that we're building value. And in some ways, it's actually a good thing that, we're in the position of pre-development in this environment to give us an opportunity to value engineer the projects, to look at other ways to save costs, and have these opportunities in the market. Because if we had already started the projects, then we would have no choice but to continue on. So the portfolio is in a great place today, and I think we're going to make our projected return, if not more.
Next question from Greg. What's the pipeline look like for new sites deals? Well, just kicked up. That's a great question. We currently have about 6 deals in the pipeline that we're working through, making sure we understand from the developer what they're building, working through construction costs. It's important to remember for folks on the call, we have 15,000 units under construction. And so our benefit as a capital provider and co-developer is picking up what we're seeing live happening with construction costs and educating our development partners who may not have as many deals. But the pipeline is robust. A lot of these opportunities come from relationships we've formed over the last 5 years, and development deals, they don't just happen overnight. And these are deals we've been talking to developers about for the last 12, 18 months. So the pipeline is plentiful yet. We're still seeing opportunities. We think there's going to be a lot of good ones for Fund 3 as well to continue moving forward. The next question on there is, have land values come down? Land values, I'd say, have flatlined. We've seen in some markets those come down. There's always a little bit of lag in terms of expectations and reality. And we're in that gray area right now. I think you've seen projects either gotten dropped. And so I think you'll see in the next quarter or two, maybe a little bit on, because that's the one peg that can move to, if costs haven't moved, to make deals pencil more. So we haven't seen it significantly yet. That's something we're constantly monitoring to evaluate in all of our markets.
Next question is by Alexa. Thank you, Alexa. Do you have an indication of when the K1 will be available? I just spoke with our controller, Priya, the other day. She said we are still waiting for the K1s from the property level ventures. Those should be in by March 15th. We will certainly get a preliminary K1 out, by April, first week of April. That's our goal. If not the final K1, there are sometimes things here that are outside of our control, but you can expect that kind of the first week of April. And I'll grab this next question too, Kyle, because it's from Anonymous, and there's two questions here. Could you walk through the incentive structure that you have in place with your JV partners? And the other question, what does the promote carry? So yes, we have an incentive. We joint venture with developers on the ground. This, I think, is an advantage to us. We are investment managers, and we are after investment returns. Our partners are generally sponsors, developers who are on the ground. We come in and, when they've identified a property, we help with GP capital, LP capital in those situations. But it's a very different business model. And our model, as I've alluded to before in terms of risk management, we are after those investment returns, where a developer is out for more development fees, right? Two different things. One is short-term, one is long-term outlook in terms of how we approach business. And we have a waterfall within our incentive structure with our joint venture partners. And generally it's kind of a 10%. The first 10% IRR is pari passu. We both earn that. And then we have a tier up there, 10 to 14% might be a 20% split. And then 14 to 18 could be a 30% split. And then above 18 is maybe 35, right? And we have much more leverage in this market. What you really have to get to is under our scenario, what is the dilution between our base case scenario and then after we pay our partner? And generally that's about 5 to 10 basis points. So we think it's well worth it. They've added value to come into a project that's sometimes nearly shovel ready, is a huge advantage. And it gives us an opportunity to be able to spread our capital around multiple cities and states. You also asked the question about what is our promote carry at the fund level, and that's 15%. And the reason why most funds are 20%, but we actually factor in that we're already paying the manager. So effectively, investors are paying 20%, 15% to us, and then another 5% to our partners on the ground.
Next question on there from David on the live chat. Can you give us a sense of what changes would need to occur from current capital economic market status quo for Origin to decide to walk away, sell land from a project that's underway? I mean, if a project's underway, once Michael stated, we need to move forward with that project. However, projects like Edge Hill is an example where we continue, once we approve a deal, doesn't mean we're going to do a deal until we start going vertical. We're constantly evaluating construction type, how that fits in, where have costs gone. Good news is costs have seemed to stabilize, but if costs go up 30% like they have in the last 18 months, no projects are going to move forward. And that's not just an Origin thing, that's the general market. And if projects would go forward, that's not a true fiduciary.
Yeah, I got another great question from Anonymous. Thank you for watching multiple webinars. In the Growth Fund 4 webinar, they spoke about lowering expected returns as of today, whereas in this webinar, expected returns don't seem to have changed at all. What is the reason for this difference? The simple reason is timing. Growth Fund 4, that is that has another kind of 3 to 4 years of life on that fund. This one has 10, 15, even 20 years. So when you're holding real estate for that period of time, when on a shorter basis, you're going to be much more impacted by these disruptions in the capital markets and issues of that nature. I'm not saying that it can't happen, but I think in the markets we're in a very good position. And the long-term growth rate, which is what we're after, there's going to be, potentially a dip in the next 12 to 18 months, maybe not. That's our prediction. And then we're going to get more on the long-term trajectory up there. So that's the difference between what you're hearing on Growth Fund 4. That fund only has a 4-year life, and we're already 1 year into it. So it's a very, depending on when we deliver that could be very different in terms of what those expected returns are.
I'm just looking through the questions, Michael. It looks like a handful of these have been answered.
Yeah, let me, there's an anonymous one here as well. What factors would you consider in deciding to add to this Fund 2 investment or waiting for Fund 3? It's one thing, it's about capital availability. So this fund will be topped off at $300 million once we've identified enough assets to satisfy that $300 million. Everything beyond that will go into Fund 3, unless, of course, we kick a deal out and open it up for another opportunity. Paras, I hope I'm pronouncing that correctly. Is there a preferred return for higher investment amount? Also, if you can give breakdown on bonus depreciation. Everybody has the same terms. So the preferred return in this fund is 6%. So our hurdle is above that, our carried interest. And we don't make different deals depending on the investment amount. There are fee breaks on the admin fee side, depending on how much you invest. But in terms of the other fund fees, they're all the same for everybody. And then, I got an email from our marketing director. She wanted me to clarify. I was saying that the minimum investment for the QOZ fund is $100,000. It's actually $50,000. So thank you, Melissa, for listening and correcting me. Anything else? Okay, well, here, this is kind of a personal question, and then we can sign off unless anybody else. This is kind of last call for new questions. But Michael, how do you and David think about percentage allocation of your personal capital across all your funds? It's a great question. And, I am more allocated towards Income Plus and Growth Fund 4 and the QOZ funds than I am to the multifamily credit fund. I certainly look at my exposure to real estate on an overall basis, but I'm a little biased because there really hasn't been a better place for, my money or David's money over the last 12 to 15 years. I get to see inside the deals we're looking at, the way we underwrite, the way we evaluate, the way we take on risk. And when we started this company, it was about creating an institutional quality real estate platform for people like us, for people like you. And that has guided us this entire time. So I'm probably allocated, to real estate more than most people, but that's both a function of I'm in the business and my wealth. I will tell you that a lot of, the studies I've seen out there, that depending on your level of wealth, how much liquidity, illiquidity you can handle, it's anywhere between 30% of your net worth should be in real estate, whether that's in private real estate or public REITs. But I did a webinar, it was yesterday, and I showed a really compelling chart. It was private real estate using the NCREIF index, and it was juxtaposed against the S&P 500. And if you look at multifamily real estate over any 5, 10, 20, 30-year period, it has outperformed the S&P 500. And we made a conscious choice to be in multifamily real estate. We used to do industrial, we used to do office, we used to do retail. But to us, multifamily, it's a necessity. It has built-in diversification because of the number of units. It's an inflation hedge, and we really like it. And it sort of showed the power of being in multifamily in this last cycle. And I think going forward, we're going to see it continue to outperform the S&P 500. So it's something that we're happy to talk about more, but you should probably it's a comfort level about liquidity versus illiquidity, and maybe talk to your investment advisor about that as well. All right, Kyle, any more questions here? I see some coming in.
Yeah. Question on here from Anonymous. What is the worst case scenario with this investment based on your risk management practices? I think on one of the earlier slides, Michael is noting to 5% cap rate. That includes our multi-lytics forecast in an extreme recession scenario and rent growth. So we factor that into there. I think that's where we kind of see extreme recession. We pulled in there as well on what rents would have to do on top of that to break even. So we've put that in this presentation.
Yeah, that's a stress test. Look, we're at worst case is worst case, right? Everybody loses all their money in this. I mean, there's things we can't control. A nuclear bomb going off on the other side of the world, on this side. We're looking at a world of normal, and we stress test things under 2 to 3 standard deviations. But of course, we can lose money in this fund. There's no doubt about that. What we're trying to do is share with you information today that shows you how we make money, how we stress test, how we manage risk. And I think if you're looking and you're considering us versus other funds, I said this before, you're going to do a lot better in our funds. And I firmly believe that, because you're going to do better in down cycles like this. This is where we shine, where we've done really well. Our other funds actually did extremely well in 2022 in an environment where the capital markets went haywire, because we're wired to think defensively, to think about risk, to think about downside protection in all of our funds. But worst case scenario has a lot of different definitions. And certainly if we're looking at 5 standard deviation, 6 standard deviation moves, that's not anticipated in this. And somebody asked me a long time ago, they said, well, what happens if interest rates go to 10%? I'm like, all bets are off, right? I hope you have a diversified portfolio. This is why I don't have 100% of my personal wealth in anything. This is the power of diversification, right? I firmly believe that we and this real estate, multifamily real estate, are going to do better than the S&P 500, but that's on a relative basis over years. So really appreciate your questions during this entire presentation. That came from Anonymous. Okay. Kyle, I think that's it, and we're bumping up on time here as well. So it was great being with you today here. I think this is our very first webinar together. Everybody, I'm sure we're going to see Kyle on more webinars in the future, and we really appreciate everyone staying for the entire hour, engaging in the conversation, asking us thoughtful questions, and we appreciate your partnership especially. And we're we're in a precarious time today. We're going to get through the other side. This fund is doing incredibly well in its position for long-term growth. And if you're considering this fund as well, thank you for your consideration. Please reach out to us. You can go to our website. You can download any materials there. You can reach out to investor relations at origininvestments.com, or you can email me directly at michael@origininvestments.com, and I can either answer your question or I can direct you to the right department. Thank you very much.